Welcome to the podcast series, You've Been Granted, hosted by Brian McDonald, CEO and founder of Granted. Today's guest is Greg Brogger, CEO and founder of Collective Liquidity. We hope you enjoy this conversation. And now, Brian, over to you.
Thank you and welcome, Greg. Thanks for joining me on the You've Been Granted podcast.
Thank you for having me. Glad to be here.
Yeah, we've tried to get this together for a while. I'm glad it fell into place. I know it probably won't launch until after, but this is the Monday of Thanksgiving week, and I'm just thrilled that you found some time in your busy schedule to meet with us. And I'm sure today's conversation is going to be great. You've covered so much ground in your career, especially on the private market side. Everything from, I'll let you give your full background, but just to throw out a few things, obviously founder of Shares Post in 2009. I think you were at Wilson Sonsini before that. Helped launch that private market. Way before that?
Way before. Yeah, that's where I started. Yeah, I'm a recovering lawyer. Just enough knowledge to be dangerous.
My son just took the LSAT. He finds out this week on Friday if what his score is. So I might have to follow up with you on that. But and then obviously the sale of Shares Post, or the merger with Forge in 2020. But I think we're just spend a lot of time today talking about your new venture that you launched in 2022, right after the pandemic, called Collective Liquidity. Yeah. So you have kind of a deep and vast experience on the private market side.
Yeah,
but maybe just kind of go back to the beginning, give us a little bit of what problem you were trying to solve and how each of those steps kind of helped you. And quite frankly, have you solved it yet? That would be another question I have for you.
Well, yeah. So just to come sort of full circle to when I started as a lawyer. So I started my career right out of law school at Wilson Sonsini, and that's kind of how I broke into Silicon Valley. And back then, feels like ancient times, but the tech universe, private or venture-backed companies were kind of something of a sort of sleepy backwater in private equity. Just the size of the asset class wasn't that large, and companies were going public more or less as soon as they could. So and that was with $300 million market valuations after 4 or 5 years, and different market dynamics during different periods, like the dot-com boom, et cetera, which would change that or accelerate that or slow that down. But it really wasn't until kind of that 2009 timeframe that I saw what seemed to me to be a really significant shift, and that was that private companies, the most successful private companies, were seeming to not want to go public, right? So they were more being dragged into the public markets by the regulators, by the SEC, more than seeing that as the end goal for their company, and so. I kind of scratched my head and thought about, why might that be? What's changed? And there's a bunch of different things. So regulatory, market structure, technology, all these things were leading to some fundamental changes. And what that suggested to me then, and seems to have been borne out by history, is that private companies would stay private a lot longer. That was pretty easy to see. If that happened, given the amount of equity that these companies were giving to employees and how important that was to their compensation, it suggested that you would have, this whole cohort, thousands, now hundreds of thousands, potentially bordering soon on millions of employees that had the bulk of their net worth trapped in a single company stock with no obvious way to get out except for just to wait 10, 11, or 12 years. And so that's into that, or to solve that problem, or at least address that problem. That's why we launched Shares Post, and I've been working on that problem ever since.
Well, look, you got it right. So millions, probably greater than 8 million employees of these companies today that are getting grants every year, and. I can't remember the example often given that Amazon was private for 3 or 4 years, and now you have companies that on average are private for 12 to 14 years and still going. I think Palantir might have been 17 years before it eventually went public. So you called it right in terms of the thesis and what you saw coming, and then obviously $200 and $300 million market cap is almost small when we think about private markets today. I mean, the market cap of some of the firms like OpenAI and SpaceX and Stripe, et cetera, they're exceeding many public company market caps. So, in terms of the thesis, it definitely was right. There's a lot in there, like regulatory uncertainty, trying to create a marketplace, all the things that come along with the difficulty when you think about founders and issuers, really being concerned about who's on the cap table and all of these other things that have continued to take shape. But how has that changed maybe since 2009 to today?
Well, I think when we launched SharesPost in 2009, and just for those that are not familiar with it, it was really simple. It's just a marketplace where sellers can post shares and buyers can post, bids, and we connected them in transactions and facilitated the trades for a commission. So really the simplest model. But when we launched it, it was a departure because the sort of traditional Silicon Valley, approach was one where basically all the employees are locked, sort of tied to the mast of their company ship, until there was an IPO or a sale of the company. And there's a logic to that, right? Which is if we all are in it together and nobody gets out, then we're all, significantly or similarly incented and aligned to do our very best to create, a great outcome for this company. But I think, into that, we launched SharesPost for the reasons I said. Like that works for VCs because they've got a portfolio of 15 or 20 companies, so they're diversified. It's the founders and the executives of these companies that are, all in on one company, and that's something that people could do for 3 or 4 or 5 years, but 10 or 11 or 12 years is just not reasonable. But what we were doing was new, and there was a lot of fear at the time. Fear as to what the regulators would look at it, whether there'd be a lot of litigation that would come out of these transactions, because private markets are different. The transactions are much more complex, obviously, than public transactions. There's all kinds of disclosure and information asymmetries and alignment and incentives. And so there was, frankly, a kind of circling of the wagons in that kind of 2009, 2010 timeframe. And the thought was, let's just, if we're a private company, we get to decide, and we're deciding no, we don't want any of it. And that was, probably the majority answer. But there were a few founders and a few boards that took a different view, that wanted their equity compensation to have real power to recruit and retain, that were competing with Microsoft and Apple and these kind of public companies that had just really seemingly endless amounts of cash. So they couldn't compete with a cash salary with those as a startup. So they looked at equity compensation as the basis for that. And so they wanted to make that more valuable. And so I'd say every year since 2009, they kind of very, very imprecisely, but the kind of public opinion among these boards and founders and CEOs has moved sort of 10% more favorably towards, or to being more permissive, to allowing more secondary transactions, to being willing to think about alternative forms of liquidity. And it doesn't mean, and still certainly isn't the case, that companies just want an open market. They don't want to be public. There no private company I know says I want to give up control of the secondary market for my shares. I don't care who a shareholder is. I don't care where these trades get done, at what price. They all want some measure of control. But there's, thanks to some of the work that, or just some of the companies and the new solutions that have come along, so like NASDAQ Private Market, that we started with creating tender offer programs, or obviously Forge, creating a much more efficient and deeper secondary market. Hopefully what we're doing at Collective to bring kind of more public market wealth management solutions to play. We're all trying to kind of get at the problem of unlocking wealth, because it's, just to kind of size it for people, not that it'll be a surprise, I think, to your audience, but, I think most estimates point to this, late stage venture backed companies, private growth tech companies, however you want to categorize them, as being something like $4 trillion in the aggregate. And employees own, depending upon the stage of the company, anywhere from 15 to 20 to 25% of the company. So you're talking about probably roughly $1 trillion that is tied up in illiquid shares. So it's a problem worth solving, is my point, and it seems like it's getting a little easier.
Yeah, it seems like we're taking steps in the right direction. If you call shares post and Nasdaq Private Markets, Equity, which became Forge, as kind of V1. I won't ask you to comment on which model you think is best, but we are seeing some consolidation happen, kind of a second set of consolidation happening with, Morgan Stanley announcing that they're buying Equity Zen, Schwab, of course, announcing they're going to buy Forge, and then I think even Goldman did a deal recently. So more wealth players, more large financial institutions getting involved. What that says, of course, is the demand for private shares is probably never been greater than it is right now. So the demand side, I think, is there's a line at the door. So that's not a problem that needs to be solved at this point. I think everyone's convinced that private markets holds the key to innovation and a lot of other things in terms of returns. But you also have some things that are still out there in terms of do you have to be an accredited investor? Do you have to be a QP? So there is a little bit of friction there on the buy side or the demand side. But staying with the employee side, because I think you're right. I mean, the ability to attract and retain top talent is the reason why equity grants are so important to the employee value proposition, and then also the recruiting side of things. And we say all the time at Granted, employees care deeply and negotiate hard for equity grants, but often, especially on the private side, they get super concentrated. It is their net worth. Right. They don't have, they don't always have great solutions. Tenders, if you're bigger, and that's something your company's doing, but sometimes not available. And then secondary markets are where their only access point to get some liquidity. But you've been on record of saying that the private market trading or secondaries continue to remain slow, uncertain, and expensive. Yeah. Can you unpack that a little bit more, and maybe even go into the friction point that you're seeing in the traditional secondary markets for employees?
Yeah, sure. So look, and I say this with some embarrassment, because I was at Shares Post for essentially a decade, trying to make it a more efficient, more customer friendly or employee friendly process. But just the nature of these transactions, both the regulatory requirements and then the company objectives. So the way that companies want to manage the secondary trading in their shares mean that we're not anytime soon, or really I think ever, going to see a private market that trades like the public market, because a few people have tried, and the fundamental impediment is companies just don't want an open market in their shares, and that's part of the reason they want to stay private. And if you were a board or a CEO of one of those companies, you would want the same thing. So it's not surprising, and there's all kinds of benefits that the companies derive from that, right? The lack of distraction, the focus, the ability for the management of the company to kind of set a longer term vision of the value of the company than what you probably get if you're like public markets necessarily focused on short-term trading. And so given that that's the case, and each of these companies needs to review each transaction and has bylaws and rights of first refusal that they hold or they assign to investors they're close to, and then the regulatory overlay of accredited investors and all the disclosures that need to happen, and the legal contracting needs to happen, because there's not a central depository trust corporation that makes everything frictionless. You're left with a market that trades like it did in some ways 50 years ago. So we built, and Forge and others have done a great job in evolving the interfaces that buyers and sellers interact with. But at the end of the day, where that trade actually gets put together and how it actually happens is a bunch of people sitting around a trading desk looking into inventory, trying to match buyers and sellers, and connecting over phone calls and emails to see if they can put the buyers and sellers together. There is no standardized contract, so there's necessarily bespoke legal agreements. Those transactions need to get then submitted to the issuer, who has their own set of legal agreements. They need to do a review process. So it takes, typically, and there's some exceptions. There are some probably 15 companies where 80% of the trading volume is happening, and there's probably some efficiencies that are gained there. But to the other 1,300 odd billion-dollar plus private venture-backed companies, that's kind of the process. And so it's painful to take a buyer because most of these employees have a day job, right? They're working to make their companies more valuable. They're not in the business of marketing shares for sale. It's not a process they typically find enjoyable. And it's uncertain whether they will actually find a buyer. And if they do, it's uncertain whether they'll get to a legal agreement. And if they do, it's uncertain whether the transaction will close, whether the issuer will just block it and say, just no liquidity for you, or assign it to another buyer. So there's all kinds of inefficiencies. And that's in part where we came up with collective liquidity. That was the idea of finding an alternative approach. Maybe companies had a little bit more control. And I guess the other kind of, it's not really a problem of the secondary market for private company shares that has to do with the platform, but the tax treatment of these transactions is frequently a surprise to certainly the less sophisticated employees. So and it shouldn't be, right? We all understand taxes are on capital gains, and just by the very nature of these companies going from $0 to $1 billion or more in some short period of time means that in many cases, the bulk of the sales proceeds are going to be all taxable capital gains. And in California, that's 46% in state and federal tax. Plus, you might pay a 4 or 5 or 6% brokerage fee to the platform that finds the buyer for you. So you might end up netting less than 50 cents on the dollar.
Yeah, it's a perfect segue. And, to your points around what's been granted, I think there's maybe 400 billion that could be combined private and public, and new shares being granted every year. So it's not like a one-time problem for these employees. And I always like to say that, on the public side of things, trades happen in milliseconds, and on the private side, it takes weeks or months or not at all, right? Like in some cases that doesn't happen. So collective liquidity, let's go there, because I think what you're building is unique and different. I'm probably going to get this wrong, so please correct me. I think you've raised about $100 million in terms of debt and equity.
That's the big umbrella over sort of everything that we've done. So so we've done a couple of debt facilities. We've raised some equity capital. We've got some private funds. So part of what we're trying to do, as the name would suggest, is create liquidity for our customers and our clients. And so if you look at all of those in the aggregate, it comes out to be a pretty big number.
Yeah, and so why don't you just kind of walk us through, like, what's fundamentally different about your approach compared to some of the marketplace models that we've been describing to this point? Yeah,
well, so I guess the first thing is it's not a marketplace. So we are essentially a buyer of sorts of shares. And maybe let me back up a sec. So when we merged SharesPost into Forge, it gave kind of the team and a bunch of people that had been with me at NASDAQ or at SharesPost, or I kind of met along the way in my time in the private markets, have joined me at Collective. And we had a chance to kind of, for the first time in a decade, kind of step back and look at everything that had worked at SharesPost, everything we'd learned about what companies want, what buyers want, what employee sellers want, and look at what had changed in the market. And obviously the big changes had gotten a whole lot bigger. There was a whole lot more data available, and a bunch of marketplaces had gotten started and information providers. And so, we thought that there's got to be some solutions that might be viable now that weren't when we started back when Facebook was still a private company and the very first unicorn. And so we looked into the public markets to see if we could kind of, steal a solution from the public markets that had already been proven, but just not yet made available in the private market. And we latched on to the exchange fund or swap funds, which, again, for those that are not as familiar with it, these are funds that have been around since the 1960s. I think Eaton Vance is the most well-known provider of them. I think they manage over. Yeah, well, and another great Morgan Stanley acquisition. But I think they manage something like $500 billion in assets under management, or at least that's what they're saying on their website. And the reason that this product, this fund structure, has been so successful through decades of all kinds of different markets is the tax advantage. And so essentially, if you have an over-concentrated position that you want to allocate out of, the most obvious thing to do is, well, sell the asset and then go buy some diversifying assets. The problem, of course, is if you had a significant appreciation in that position, then you've got a very significant tax bill. And the leakage to taxes really hurts, of course, your diversification strategy. I mean, it means you've got, diversifying with post-tax dollars is not ideal. But an exchange fund or a swap fund allows you to take, say, $1 million worth of Apple shares that you bought 10 years ago, or for $100,000, you had a huge run up in the value. And instead of selling them, paying taxes, you can just exchange them into a fund, an exchange fund, for $1 million LP interest in that fund. And that fund itself is already diversified, and that doesn't trigger a capital gains tax. So hopefully, I don't know if that was the most articulate description of how it works, but it basically allows you to diversify without triggering taxes by basically paying income. It's like almost as though you're investing in the diversified fund using your shares without having to sell them. And so we thought, like, if this makes sense in the public market, it makes even more sense in the private market, because you've got founders and executives, employees that are even more concentrated than they are in the public markets typically, which means the need for diversification is even greater. And second, the appreciation of these unicorn companies, almost by definition, going from 0 to $1 billion in a relatively short amount of time, means that the value of that tax-free treatment is enormous. So just to take the example we were kicking around before, and I'll just make the math easier on myself, if you had $100 worth of shares, that's mostly gain, you could take that $100 worth of shares and sell it and pay, something like 40, 50 cents on the dollar between taxes and fees, and then invest that, go buy, a fund of some kind or a bunch of different assets. Or you could take that $100, exchange it into the fund for $100 LP interest, and have that be your diversification. And over time, that tax savings compounds in the fund. And so what starts out as a pretty sizable difference, just because you've saved on tax, becomes a huge difference the longer you stay in the fund. And if you stay in the fund for 7 years, our holding period at Collective is only 3 years. But if you were to choose to stay 7 years, then you can get a distribution out of the fund, and that's tax-free too. So it just is one of the
7 years is the length of time in order to get the tax-free distribution.
Tax-free distribution out. Yeah, even if you decide to exit before then, say in 3 years, you still have the benefit of having deferred your tax for 3 years. So it gives you control over when you want to take the tax hit, and you're diversified, not just diversified, but you're diversified into a portfolio. We've now got about 30 companies. We're adding 1 or 2 every month or two. And so, at scale, we'll probably, I don't think we'll ever be over 100 companies, but essentially we're creating a kind of index of leading venture-backed companies.
Fascinating. And I agree with you, needed in the marketplace today. And I am familiar with the Eaton Vance Parametric, and I think there's a new company on the public side. I don't think I know the Cash, which is doing it as well on the public market side. And I think they're doing some interesting things, because I think they're bringing the minimum to get involved down to $100,000 level, which is makes it more accessible. And Srikanth and the team seem to be doing a great job building that business. So on the private side, though, are the corollaries the same across the board? Meaning, do you have to have a real estate component to the portfolio? And then how do you construct the portfolio overall?
So yeah, no worries. I was worried. I got a dog over in the other room, but he's cooperating. From a tax tax code point of view, there really is no difference between the two sorts of funds. It is not to minimize what they're doing at Cash at all. I think, as you said, they're doing a great job of gathering assets, but it's just a different set of problems to solve. And so certainly particularly the way to value the shares and create a scalable model has been probably a bit more of a challenge for us than it was for Cash or anyone working on the public side. But yeah, so the tax requirement isn't specifically real estate. It's what the IRS calls, quote, qualifying assets, which is a defined term. And there's a bunch of different assets one could use, but we do what Eaton Vance and Goldman and everyone else who has an exchange fund does. We basically have part of our fund exposed or invested in private real estate partnerships.
Okay. And then what about the rest of the portfolio construction? I mean, because you mentioned earlier that 80-90% of the trading is happening in call it the top 10 or even top 50 names. But how are you putting the portfolio together? How do you decide what's in it? And if I wanted to participate with my shares, not me personally, but one,
right.
what would they need to know or have in order to do that?
Well, so one of the foremost problems that any exchange fund needs to solve, and in a really compelling, credible way that's kind of hardwired into the fund, is addressing the negative selection bias, right? So, and other exchange funds have gotten into trouble with this, or with failing to address this problem, and that is it's tempting. You can grow much quicker. I mean, we've turned away, I don't think I'm exaggerating, hundreds of millions of dollars worth of shares that were offered to the fund. Because our investment committee just wasn't comfortable with the company, right? So what was super important to us in building a business that was going to be successful over the long term was that we had a really high quality portfolio. Because you can gather a lot of assets very quickly, but if people are giving you shares in companies that they really want to be out of rather than just looking to diversify, then naturally you're not going to be attracting probably shares in the best companies. So what we do is have an investment committee that pre-selects companies that are eligible for exchange. So out of, they call it 13 or 1400 unicorns, there's about 130 companies we've identified so far that we'll accept shares from. And one, in order to define the best private venture-backed companies, we basically follow the leading VCs. So we look at the top decile VCs, and we look at their portfolio, we look across vintages, and we select the companies that we think are the winners across vintages. And what that allows us to do is create an index of, the math doesn't quite work to say we're picking the top decile VCs and that we can pick the top decile companies within their portfolios, but that is the attempt. That's what we're steering towards. And so it not only gives us comfort that the returns are going to be there as this market continues to develop over the next however many years, but it also lets potential exchangers, so each exchanger coming in from one of these companies knows their company and knows, is excited about its future trajectory. But they'll typically know some number of other companies in our portfolio, but it gives them some confidence that if Benchmark or Excel or Sequoia or Andreessen is backing a company, and particularly in many of our companies, you've got 2 or 3 of those firms, it's a real strong signal that this is likely going to be a successful company.
Yeah, that's a great explanation and super helpful. Maybe a couple more things on what you're doing at Collective. The first is you have kind of a novel or innovative approach to how you value. Yeah. It's not the same as maybe not even competitors, but some of the other secondary market pricing. But maybe give us a little bit of detail on that.
Yeah. So in order to make our model scalable, in order to be at any given time, someone can come to our website and any of the companies that are eligible for exchange, and even other companies as well, we're willing to give an immediate price. Remember, we talked about at the beginning of the podcast, how difficult the process it can be, because price discovery is part of, typically the transaction process on any of the marketplaces, right? So you got to go talk to 5 buyers to figure out who's going to pay what before you know what the offer is for you. So we wanted to shortcut that time frame. So we wanted to be able to publish essentially an upfront price. I feel like a car buying site. It's an upfront price. But in order to do that, we knew that we couldn't do the traditional sort of an underwriting process where, and this, for example, when we were at SharesPost, we managed a fund, got to almost $1 billion, or actually a little over, ultimately $1 billion in assets under management. They would have basically a series of one-off negotiations in a traditional format. And that's really what every secondary fund does, or every cash buyer. But we wanted to take a different approach. So what we have done is created an algorithm that looks at basically every pricing signal. If you got a bunch of venture capitalists around a table to do that traditional process, what would the questions that they would ask of the seller or of the company? Like, what's your revenue? What's your, what are other shares trading for? Where'd you do your last financing? What do your liquidation preferences look like? What's the capital structure? And we took all of those signals and we baked them into an algorithm, because the other super important thing that every exchanger wants to know is that the valuation of their shares going in is going to be based on the same, at least method, if not the same algorithm, the rules-based engine that values their LP interest on the way out. So no, call it, games can be played with using different valuation methodologies for different purposes and at different times. We wanted it to always be the price on the way in, and lenders that lend against our portfolio know that the same valuation was used for purposes of their transactions. And when our LPs look to redeem, when they need to exit the fund, we wanted them to be confident that they get full value for the growth of the portfolio. So it was sort of an apples to apples pricing, and really capture the growth over time in the portfolio. So in order to do that, for example, we get data from a whole bunch of different providers. And so Forge obviously is one of them, and they've done a really great job at evolving the data product that we built at SharesPost. And others, Caplight and Notice and Zenbato and NASDAQ Private Market, all provide or have provided at different times input by way of API. So that's how we're able to do kind of dynamic pricing, and we get the capital structure by looking at the company's certificate of incorporation, and we build a kind of a waterfall model. And it is, as I said, it gives us the ability to offer an upfront price, and one that is reliably calculated today, tomorrow, and down the road years from today.
That's great. A lot more intensive than I would have expected, and certainly a lot of not just signals, but high quality data points that you can bring into that pricing.
Well, and it also it is quite elaborate. So I think that's kind of our core IP. And so there's about a 40-page white paper that we've kind of put together to describe it when we're talking to partners and lenders and such. But just to kind of give you an example, one of the other things that we need to solve for is for each of these companies, these price signals sort of ebb and flow, and as time passes, the quality or the relevance of signals decays. And so we have a decay rate for each signal, various weightings for the signals, and then another super important component of the algorithm is that it evaluates the quality of the data informing the price, because we just have to recognize that there are some companies that did a primary financing yesterday with a large round with a notable VC, so that we can be very confident in the price that established, and we use that to determine our price. But if a year or even a few months passes, obviously the companies change, the markets change, and we cannot be quite as reliant on that price. And so then other signals like secondary market bids and asks and secondary transactions take on more of a role or have more weight in the valuation that we see for that company. And at some point, if there's no secondary trading and the primary round was too long ago, then our confidence in that price drops so low that we just can't transact. But then that company a week later will do a primary financing. And so there's just, our ability to accept exchanges and price within this target portfolio of ours is constantly in flux.
Wow. So the white paper is interesting. Certainly not something you publish for everyone else to see.
Yeah.
That's some of the secret sauce. But
share it with you though, Brian.
I'd be happy to read it. Might take me days. I'm more of an audible than I am a reader.
Yeah.
But no, so digging deeper and maybe going back to where we started on liquidity, right? That seems to be still a challenge for participants, but I think you have a couple of unique things you're doing there as well. And so why don't you talk a little bit about the loan provisions? Because all the time we have clients that say, like, I have, millions of dollars in my company equity, and, I can't really sell it or don't want to sell it.
Right.
Even if they're thinking about the exchange fund concept, which I think is terrific. How do I get access to liquidity if I need it right now? I want to buy a house and haven't been able to do that.
Well, and yeah, it's a great point. And sort of the other half of our business, because about 30 or 40% of our customers, depending upon the quarter, will look to do just the exchange. They don't need liquidity. They're just looking to manage their risk, right? So they want to call it a floor under their net worth. Maybe they've been around through a cycle or two, and no matter how promising their company's doing, they're like, I'm not comfortable being all in on one company for a decade. Which, I got some interesting stats I can share with you around that. But the majority of our customers do have a need for near-term cash. They want to buy a house, they want to put kids through school, or whatever their personal capex might be. And typically they've looked into the market, right? Either maybe there's not a robust secondary market, or they need to move faster than the typical secondary transaction could be put together, or they don't like the prices, or particularly they don't like the tax hit. And so then some of them look to some of the, call it single stock lenders that have been in the market for some time. But those can be challenging products as well, because if you're from the lender's perspective, if your collateral for that loan is just a single stock, and that's hard to value because you got to get financial information from the companies, revenue, financial, typical financial metrics in order to assign a value to the company so that you can assign a value to the shares that are serving as collateral, that can be difficult. So they're labor intensive, they're high risk. And so, between those two things, what you get is some very expensive loans, if you can get them at all, at frankly, some very low LTVs. So not a great deal of cash. So for $100 a share or $100 worth of shares, typically maybe $15 or 15 or 20% LTVs are, I think, kind of commonplace. So, but with call it the magic of an exchange fund, or the alchemy of taking a single stock position and turning it into part of a portfolio where no company is worth more than 5 or 10% of the overall, you significantly de-risk the collateral from the lender's point of view. And if you provide quarterly liquidity to lenders, so much the better. And if you're valuing the portfolio based on an algorithm that is rules-based and transparent, and they can look into and look at a dashboard and see, how we're getting to the values we get on a company-by-company basis, and how it ladders up to basically the value of the fund, and so the value of an LP interest that is the collateral for their loan, they get a lot more comfortable. And that means that the loans can be significantly lower costs, and it's significantly higher LTVs. And so we're working with, we've worked with two sort of lending facilities that we already have in the market. One with WebBank, which is a program that was lending at 60% LTVs on a non-recourse basis, no stock fee, which was really remarkable. We're kind of that capital has been expended, or we've fully allocated that. So we went on to work with another partner, XP Asset, a firm out of Brazil. And lend there in a more of a forward structure, where we buy back part of the LP interest from the LP for cash, and there's a forward structure there. So look, and we're now talking to multiple different banking partners about lending against the LP or against the fund interest as collateral. And I think the way it's going to work out is we'll be sort of the advocates for our LPs. We'll always be willing to talk to any credit provider about how they can use their fund, use our fund in their credit program. And the thought being, given it's a diversified fund that's transparent and provides liquidity, likely will do, or almost certainly will do, far better for them than if they're negotiating with a lender with just using a single stock as their collateral.
Wow. I think that's great. And it's giving them access to, cash they wouldn't have much more quickly. And it sounds like neither of the lenders that you're working with are taking, a percentage of their equity as part of that loan.
No. So, the XP program is a forward program. So we're buying back part of their LP interest from them. So in a sense, buying their equity in the fund. But the lending product, there's as of yet, we're not charging any stock fees associated with that. And just to point out, it's probably obvious, but if the exchange is tax free and the loan is tax free. So if you, again, going back to the same example, I got $100 worth of shares. Let's say it's all gain, just to make the math easier. I could sell it and pay 46% state and federal if I'm in California, 5 or 6% to a brokerage commission.
Yeah.
About 50 cents on the dollar to go buy diversifying assets, or I can take $100, exchange it for $100 LP interest. If there's a lender that would go as high as WebBank did at 60%, you're taking 60 cents on the dollar off the table with no taxes, either on the exchange or the loan. So it's just kind of a no-brainer and hard to see how a conventional stock sale, if you're in that set of circumstances where you've got a sizable taxable gain, hard to see how you can do better than an exchange with a loan.
No, it makes a ton of sense, and certainly innovative solutions. Again, you're bringing to market. Maybe talk a little bit about like take rate or just your ability to find. Again, getting back to that supply side piece, like. Yeah. Are you doing traditional advertising? How do people typically find collective liquidity?
Yeah, so our go-to-market is multi-channel. We're still small and scrappy. We've kind of spent the last couple of years building out the algorithm, building out the initial positions in the portfolio, and just kind of proving this concept worked, and the companies would receive it well. But I kind of lost the thread there. So go to market, right? So I mean, one of the the advantages and disadvantages at the same time to our business is that we have a very defined set of companies that are eligible for exchange. So there's, call it 130 odd companies. So it's relatively easy to identify employees of those companies online, and so we do have a small budget just for ads. Really not promoting collective as much as promoting an exchange fund as a solution for these executives. Now it turns out we're the only exchange fund in the private market, but we really do believe that this product is beneficial. And I hesitate to say it sells itself, but it's not really that subjective. It's really kind of a math problem. Like what's the tax savings? How does the tax savings compound over time, and how much of a difference does that make? As I said, it's not necessarily a solution for everybody, but I think a kind of a typical process or kind of path to a customer or to a company relationship is one where a mid-level employee will find us. They'll be looking for how do I reduce my risk or manage my risk or hedge my position or something like that. Our content about exchange funds and risk management brings them to our website. They enter into an exchange over the website or talking to our sales team. And so we submit that transaction to the company. So as you would expect, every transaction we do is submitted to the company for approval. And often it makes its way just because it's different. People, we're the first exchange fund. We're not, Forge or any of the marketplaces. So it makes its way to the CFO's desk, and they want to have a phone call because, particularly, CFOs probably have heard of exchange funds, not known it was possible in the private market. And so we have a conversation with them, and almost universally, whether they think it's the right fit for their company at that time or not, they appreciate the novelty of the idea and the usefulness of the idea. And they understand why someone would want to diversify and how borrowing against a diversified position is better from a tax point of view than selling. But it's not always the case that the window is open, so to speak, at the company. But often it is, and often the CFO himself or herself will then opt to say, I want to do this for myself. And then that introduces us often to the CEO, founder.
Yeah, that's what I was going to say. I mean, almost each CFO conversation is a win in and of itself, because as you kind of work through that, it makes it available potentially to more employees, as you said, even her or him involved, but also you don't have to keep going back every time, because there's a little bit of you do probably from a procedure standpoint, but there becomes a common understanding of what's going on and makes it easier for the next trade. Yeah.
And as we get larger, we're very focused on launching company-wide programs. So our challenge right now is size, right? So we can only, in order to preserve the diversification of the fund, we can only do so many exchanges of whatever value in each individual company. As the fund grows, those get bigger and bigger. As the denominator grows, each of these transactions can be larger. But that's definitely the direction that we'd like to go. because unlike, I think tender offers are kind of, one of, if not the kind of leading form of liquidity, particularly for those companies that are not in the 10 or 15 that are where there's frequent trading. Those are difficult transactions, right? Those are for the company, right? They got to raise the money, they got to make the disclosures, they got to pay the platform that's going to manage the liquidity program, and it happens. It's all got to close on one day, and so they do those once a year. And once those programs close, the line starts forming outside the CFO's door, right? For someone who missed the tender offer program but needs to buy a house or some capital need. And so we think of ourselves and Collective as a complementary product. So in some cases, it does make sense to sell, maybe in a tender offer program, but for many employees and for many companies, having the ability to do an exchange and potentially borrow against that LP interest they get in the exchange just makes a lot of sense.
Yeah, that's great. And you've talked about Collective being a wealth management products platform, and so as the individual is trying to make a decision, and again, we work on this a lot with Granted, both with individuals, but more importantly with the advisors who serve them. But you're really positioning Collective as a concentration risk management tool where individuals get super concentrated. So it's not that they need the money in some cases, like the other side of that coin is that they don't need liquidity now, but they are worried about their concentration and concentration risk, especially with their salary, their bonus, and then so much a part of their net worth tied to that one private company name. So how should employees and their advisors be thinking about concentration in their private equity? I mean, how do you guys help them solve that problem?
Yeah, well, so we did, I thought, that really interesting bit of research, which I think I think everyone sort of understands kind of at an intuitive level. But when you see the way the numbers actually kind of played out, it was sort of at least eye-opening for me. And that is that we, just to get a sense of what the exit rate of these even successful companies. So we looked at between 2010 and 2015, with the help of PitchBook, we looked at every company that had raised a Series C, and now a decade, or in most cases more than a decade later, how many of those companies had exited at the Series C price or higher, and it was only 38%. So even companies that had just closed around that typically or often would put them in the kind of unicorn stratosphere, only 38% of them had found a way to create meaningful liquidity for their employees a decade later. So, but the other fascinating, maybe more fascinating factor that was, had you invested in every one of those Series C financings, you would have over, I think it was the exact numbers, a 5.03x multiple on your invested capital. And obviously, what drives this is the companies that are in the 38%, drive enough returns to make up for the 62% that aren't. But if you're a financial advisor, or if you're one of these employees and you're sort of stepping back and you're kind of putting your emotions and excitement about your company aside, and you just said, look, if I was not an employee of this company, would I invest 100% of my net worth in this one company, no matter how good it looks today, right? And again, people who've been around through a couple of different cycles know 100 stories of people who just closed around, the world was theirs, nothing could go wrong, but then a new technology emerges, or there's a competitor that comes out of the woodwork, or there's a regulatory change, or their company knocks it out of the park, but then the markets crash and the IPO windows close, and then competitors catch up. So there's just so much that can go wrong with any individual company. But the long-term returns of a diversified portfolio, again, it's just the math. And anyone who has any kind of finance training, it's the first thing you learn about investing is, I think it's, Markowitz, the Nobel Prize winner, said the only free lunch in finance is diversification. I'm butchering that quote, but as I said, it's nothing special that we're doing. It's just the math of diversification.
Was that the random walk?
I think that I want to say that was somebody else, but I don't know. I should have done my research. I should have my quotes at the
I'm going back to the 80s as well, so it's hard to remember. So there are a few things in there I just kind of want to touch on quickly, and then jump into a couple of other questions before we wrap up. But one thing we see a lot from advisors is just the struggle with what to do with ISOs, the exercise decision. So when someone has ISOs that are about to expire and they could exercise and contribute to your exchange fund, how does that change the analysis? Maybe touch on that. And then I have some questions now coming to my head as I think about traditional exchange funds around vested versus unvested, but maybe hit the ISO question first and then touch on the vested versus unvested.
Yeah. So yeah. And I want to be careful because we do have experts in the company that are tax experts, and I'm not one of them. But if anyone contacts or reaches out to us, we do have some expertise there. It's just not me. But yeah. So ISOs, incentive stock options. There is a challenge, not challenge for us, but we talked about some of those cases where it's not necessarily the case that the exchange is the best option. And there's more than just whether there's an ISO or not that goes into that calculation. But an ISO requires, if you sell the shares within a year of exercising them, it's called a disqualifying disposition, and you basically lose the deferred tax benefit. So it may still be the case that the exchange is your best approach on an after-tax basis, but there is an additional tax there. So compare that to an NSO or to somebody who's already exercised their shares a year ago, in which case there is no disqualifying disposition. So it's one of the factors that we consider, and we have some calculators on our website that allow people to kind of plug in these different assumptions: ISO versus NSO, different assumptions for exercise price versus value today, and they can basically compare side by side what a stock sale looks like on an after-tax basis versus an exchange. The other thing I'll say is we love talking to financial advisors. So our close rate on a transaction or an exchange is significantly higher when there's a financial advisor involved, because they have heard about exchange funds, they understand the math, and have a kind of a disciplined approach to appraising our offering, and it typically comes out very, very favorably to us. And so we're always trying to reach out and provide them with tools and information. Happy to do it on really whatever terms the advisor is looking for.
Yeah, no, it was actually going to be one of my next questions, because the main population that we're serving right now at Granted is the financial advisor. We believe that if we can elevate the conversation between issuers, the individuals receiving the awards, and then the financial advisors who should be serving them, it's better overall outcomes for everyone, and certainly for the individuals that are trying to build real wealth through the awards they're getting from their employer. I saw a stat the other day from a Schwab study actually that said 29% of individuals who receive equity compensation actually understand how it fits into their overall portfolio. The good news is that jumps to, if they don't have a financial advisor, they understand. The good news is that jumps to 44% when they have a financial advisor, but still 44% is far below the 100% that probably should be. So
yeah, particularly when you realize how much of their client's net worth is tied up in that. Yeah.
Yes. So if you're engaging with advisors, if advisors are reaching out to you, I mean, how do you like to work with them? What kind of soundbite would you give them if they're listening to this podcast on how collective liquidity could help them solve problems?
Yeah. So I guess typically there's not a lot of explanation that we need to make to the financial advisor about diversification or even about what an exchange fund is. So typically the only questions we're really answering for them are how is a private market exchange fund different? Right. So to your question, is the tax treatment the same? Do you have real estate in the fund? What are the other companies in the fund? Things that we've already kind of talked about in the podcast so far. I guess in terms of how we like to work with them, we're just getting the part of our growth strategy or our marketing strategy where we're trying to build, call it distribution network or networks or relationships with financial advisors. And so we've put together some tools for them. So if an advisor comes to us and wants to understand our solution, and particularly if they have clients of theirs that might need would benefit from our solution. There's a portal that we make available to them where they can, one, see our pricing data. They can model out what an exchange would look like, compare it to a stock sale, news and watch lists about the company. So nothing that's particularly rocket science, but just something that makes it a little bit easier to, one, for them to understand on a specific transaction for a specific company, what we'd be able to do, and then be able to maybe educate their client a little bit better by showing them some graphs and charts based on their specific situation as to the difference between selling shares and exchanging.
Yeah, that's great. And going back to one of the things I mentioned earlier, if an advisor is working with a client and she's got vested and unvested shares, that she's looking to potentially put in to do the exchange with, can she use both vested and unvested? I mean, you talked about forwards earlier, but I would think if something would happen, it could break the contract. But how do you think about vested and unvested? Because it doesn't really exist on the same way on the public side.
Yeah, no, it's true. And so I'll just speak for where we are now. Like, never say never. And depending on how companies look at forwards, we may, shift our policy to be, more open to alternative transaction structures. But where we sit today, we require for each transaction that the shares actually be transferred into the fund before we issue the LP interest. So that means that it can only be vested options that are exercised. And we can, at different times we've had option exercise loan programs with WebBank facilitated one. So it's sort of a bridge loan. So the way it would work is if an employee had an option exercise, the bank would advance them the funds to exercise. The shares would issue. We do an exchange. The shares would transfer into the fund. We give them a more permanent loan, and out of that more permanent loan, we pay off the option exercise loan. So
some sort of 30 to 60 day type thing.
Yeah, like, as I said, like a bridge loan that just for short duration, just to kind of get over the catch-22 of the shares have to transfer before we give you the LP interest. The LP interest has to transfer before we can give you the loan, but all of that requires that the shares the options be exercised.
Yeah, that's terrific. So I have a couple more questions for you, and then I promise to let you go. But I just want to zoom out for one quick second and talk about the competitive landscape overall. You've got Carta doing some new things. We talked about the other players in the marketplace and some of the acquisitions that are happening now. As you mentioned, right now you're the only player in the exchange fund space on the private market side. But where do you see things shaking out? I wouldn't even call it competitively. Where do you see the marketplace or the ecosystem evolving next?
Well, I think, and again, I think you, in your different roles through the years, have know more substantially more about this than I do. But what it seems to me, or seems to us at Collective, is that we had kind of this run up in 2018, 19, 20, 21, where valuations and the size of the market was growing very rapidly, and perhaps too rapidly, so that in early 2022, you have kind of a crash. So a lot of the acquisitions and call it strategic partnerships that were being put in place during 2021, including, for example, Morgan Stanley's acquisition of Solium and ShareWorks. And I think those got put on hold. I think there was kind of a nuclear winter of sorts that descended on the venture markets during 22, 23, 24. Valuations were cut in half. It was not clear which marketplaces were going to survive. And so I think what we're seeing now, as maybe there's a little bit more solid footing under the market, valuations of the companies, bid-ask are increasing again. Bid-ask spreads are narrowing.
Tighter, yeah.
And it remains clear. I don't think it ever changed, even with the downturn in the market and valuations. It remains clear, or maybe even clearer, that the fundamental trend of private companies staying private longer is not reversing itself. These private companies are not dying to become public if they can stay private longer. And so, as large as the asset class has grown, it seems like it's just going to continue to grow. I mean, I saw a stat. I think it's something like 70% of all companies that are $1 billion in valuation or more and growing at 30% or more are now private, which is a sea change from where it used to be. Yeah, and so I think a lot of the larger financial institutions, the investment banks and the wealth management platforms see the writing on the wall that all of them are going to need some infrastructure to serve customers in the private market, because that's where wealth is being created. These are arguably the most valuable wealth management clients in the world. We see them every day, right? Where they are newly minted millionaires. They have a screaming need for a financial plan. Therefore, they have a screaming need for financial advisors. And just none of that has been available to them historically because of these market inefficiencies that we're talking about. So I think it's a not too surprising return from these large institutions now that the market has recovered to, helping to knit together platforms and relationships and partnerships into the new, next generation of private market infrastructure.
Yeah, totally agree. I mean, we've been on record of saying more wealth is being created in the workplace than almost anywhere else. If you think about retirement plans and equity compensation, and quite frankly, equity compensation is the more complex, I think, in many cases for someone to try to solve, the challenges they might be facing. And a lot of those challenges are just pure decision making, in real time, especially as grants happen, frequently, and vesting happens annually at least, but sometimes quarterly, monthly, and so on. It's an ongoing, problem for individuals to solve.
Well, I think if the market has grown from, in 15 years from 0 to 4 trillion.
Wow.
Despite all of that inefficiency and impediment, starting from zero infrastructure, and as I said, a circling of the wagons where people were trying to kill this industry, these marketplaces, in their infancy, and nonetheless, just the amount of capital and the demand, dragged this market into existence. As players like Granted, as on your side of employee compensation and management and analysis, all the way across, things that Forge is doing, things that Morgan Stanley is doing, it's only getting more efficient. It's not getting less efficient. There's more data, there's more information. Transactions are easier than they were. There's more solutions like collective liquidity. So if it was already happening when there was no infrastructure, and now infrastructure is getting built and coming online, it suggests to me that this, again, it only accelerates further.
It's definitely growing, for sure. And so, and I don't think it stops here. I mean, I agree with you. I don't think private markets ever becomes public markets.
Right.
It will probably remain inefficient almost by design. It might be a feature, but in general, closing piece of advice from you, Greg, again, someone that's been around the space your entire career. I'll even count the Wilson Sonsini days as, they've been such a big part of the private market ecosystem. I'll count that as well. But if you have someone that's, super concentrated and, has, large grants in their portfolio, in their total net worth, total wealth, and they're trying to make a decision, what advice would you give someone from a late stage private company? What would you tell them to do first?
Well, I guess it's probably not overly controversial advice, but I guess what I'd suggest is to separate emotion and loyalty and excitement for your company from the investment decision. So recognize that you're, ideally, if you created wealth, now's the time to create a financial plan, a long-term financial plan, and to look at that as though you are an investor in your company, because you are, right? This is your for most people, their primary investment capital is their labor and their time, but it's still investment. And so therefore, do you want to, remain concentrated, which starts to look like speculation or even like gambling, with your future, because you just, particularly if the horizon to an exit is 5 or 6 years down, nobody knows what's going to happen 5 or 6 years from now. And that was before people started talking about AI and all the other changes that are happening. The pace of change is not slowing down, and therefore a risk to companies, even companies that are winning today, is great. And yet as an asset class, it makes an enormous amount of sense. So Obviously very self-serving on my part to give this advice, but think about managing your risk dispassionately and programmatically, and I think that leads you to a better conclusion. You'll sleep easier at night. And we don't suggest that anyone exchange 100% of their shares. Typically, people are exchanging 15 or 20% of their positions, just as I said, to kind of put a floor under the net worth and give themselves some liquidity and some breathing room.
Yeah, it makes complete sense, and I think we're okay with you talking your book here. I think it makes a ton of sense. I always say that if somebody came to you today and said, we're going to put 80-90% of your net worth all in one stock, and I want to be your advisor, you'd probably say, there's no way I'm going to be my advisor. So if you flip the script and look at it the other way, you're probably taking on a little too much risk. If everything's up and to the right forever, then it's a great decision. But if not, you might want to.
Yeah, 62% of the people end up regretting that decision.
Totally. That's right. All right, Greg. Well, thank you so much for spending the time. Again, I hope you have a wonderful, Thanksgiving with your family. I know you're about to jump on a plane. I appreciate you being here with us. If those want to find Collective Liquidity, how do they go about finding it?
I'm just Greg at collectiveliquidity.com, but anybody who's in your audience, be happy to speak directly to. So just GREG at collectiveliquidity.com.
One of the great things about being a founder is you get to take, you're the first Greg, you're the first Brian, so that you can use Greg at collectiveliquidity.com or Brian at granitequity.com. So thanks again for joining us today. Thank you, Greg.
Appreciate it. Cheers.
Take care.
Thank you for joining us for this episode. We hope you enjoyed Brian and Greg's conversation. Be sure to tune in to our next episode of You've Been Granted in January. Please stay connected with us on LinkedIn and YouTube for updates on past and upcoming episodes.